Hello friends, I welcome you all to this live webinar come panel discussion. We'll be discussing about mutual funds and we have elite panelists, all are orthopedic surgeons. I'll introduce them to you. Dr. Harpal Singh Selli is Professor of Orthopedics from Ludhiana. He has done his MS and MS from Chandigarh, and he has special interest and expertise in pelvic reconstruction surgeries, infected non-unions, difficult non-unions, and deformity correction in adults. He has more than 30 international and national publications with awards at OTA. He has been active investor for many decades with first exposure to stock market through Reliance G debentures, and then he never looked back. He has he was totally fundamental investor with common sense investing as core, and now he is trying to learn price action. And Dr. Hemant Patil has done DORTH and ENB. He is joint replacement surgeon with fellowship from Germany. He is currently working as a chief orthopedic surgeon at Herem Orthopedic Center in Pune, and he is currently treasurer of IMA PCB branch and executive body member of PCOA. He is financial enthusiast since 2013 when he was introduced to mutual funds by his father-in-law. Since then, he is actively tracking his mutual fund portfolio and investments. He is active in trading circuit since last 3 years, and he has cleared derivative segment certification from NISM. And Nitin Bagli sir does not need introduction in orthopedic circle. He has done his MS Ortho from Pune in 1983, and he is trauma and general orthopedic surgeon practicing in Pune. He is past president of Pune Orthopedic Society, and he was executive committee member of MOA for 3 years. He was managing committee member of IMA Pune for 10 years and managing committee member of Hospital Board of India Pune chapter. He has been active investor in equity market for more than 3 decades now, and he has learned the art of investing on fundamental analysis. He had his share of his failures, but he has done tremendously well in share markets. And Dr. Vishwas Phadke is an orthopedic surgeon from Sangli. He is practicing at his own nursing home, and he is also working as associate professor at SSPM Medical College, Sindhudurg. He is passionate about art and science of money. He has passed examinations of NISM, and he has prestigious license of registered investment advisor of SEBI. He also has registered retirement advisor of Pension Fund Regulatory and Development Authority license. Then let us now discuss about mutual funds. A very common question is when we want to select mutual funds, most of us don't know where to find the information about mutual funds, how to compare them and where we can find that information. So this is very useful website, Value Research Online. On this website we can find most of the information which we are going to discuss, various parameters, peer comparison, past performances, everything is available, and it is very easy to use website. This is their website's homepage. Here we can see that we can click on funds and we can see information about mutual funds. On right side at top we can see that there is a search icon, and in that we can search any mutual fund and we can get the information about that mutual fund or fund house. And next question is whether we should select direct mutual fund or regular mutual fund. When mutual funds started, all of them were regular mutual funds. In regular mutual funds and direct mutual funds, only difference is the commission which goes to the agent, and usually it is shown in expenses. So direct mutual funds have less expenses, which are usually 0.5 to 2% less than regular mutual funds. Does this small amount in percentage make any difference really? We can see that I have done some calculations to check that. Here the calculation is for 25 years with expected annual returns of 10%, which average mutual funds easily give, and investment is taken as 30,000 rupees per month. So if with these parameters, if we invest for 25 years, the total amount expected is 4 crore at end of 25 years, and this is 10% annual return. Suppose this is regular mutual fund. Now direct funds are available and they have less expense, means their expected return will be more. So if the expense is 0.5% less, then our returns will be 10.5%. On that basis, if we do calculations with other parameters same, then in 25 years with 30,000 investment monthly, difference is around 36 lakhs. And if we check it for 30 years duration, then difference is around 78 lakhs. If the expense ratio is 1% more in regular, then with that 1% calculation, it will be 11% expected annual return, and the difference is huge. It is more than 1.5 cr difference between 10% and 11%. So there is no alternative. We should always go for direct mutual funds, because regular mutual funds give lesser returns. This is over a period of long time. Then there is another option, which one to select, growth or dividend. So always growth option should be selected, because our money is invested and it is not given back to us in form of dividend. The shares dividend is totally different. They give dividends from their profits. However, we give our money to fund houses and they should invest that money in share markets. If they give dividend, means they give us our money back. So that is useless dividend. So with this information, if panelists want to add anything, I request them to add their remarks. Otherwise, we can go ahead with panel discussion.
I will add one thing. Along value research online is a fantastic, no doubt. But again, one more site is free of cost site is a Advisor Khoj.
Advisor Khoj.
Khoj, KHOZ. Advisor Khoj.
Okay.
It's fantastic
One word?
site.
One word?
One word.
One
Yes.
word, okay. Advisor Khoj.
Advisor Khoj is fantastic for mutual fund.
Okay.
And it's free of cost site, and they give the fantastic comparison with different type of varieties also. Let's proceed.
So we'll go ahead with our panel discussion now. Very common question is about how to invest. Which platform is really fantastic to invest in mutual funds? So which are the platforms available and which one is best? So I'll direct this question to Dr. Hemant Patil, and we'll start discussion with Hemant. Hemant, please go ahead with your.
Thank you, Prashant. So coming toward the first sub question, how to invest in direct mutual fund. So there are a number of ways in which we can invest in direct mutual fund. For younger generation, we can anytime opt for online registration for direct mutual fund. For older generation who are not very much tech savvy, offline mode is also available. They can directly go to the respective office, which is easily available in all the major cities, and fill the form and start routine direct mutual fund instead of routine. And in online mode, we just need to be a bit tech savvy. We just need to navigate the website, and we can easily do it on our own. We don't require any other person's help. There are almost 40 mutual fund houses, and each and every one of them is listed on the website. We can have a option of choosing what we say is a la carte menu by going on their individual mutual fund website, and say supposedly if someone wants to invest in HDFC mutual fund, he can directly go to HDFC website and he can choose any fund which is offered by that fund house. Or we can have a supermarket approach wherein all the mutual funds are being listed under one website. Such websites are called as aggregators. And Association of Mutual Fund in India have floated a common platform for this, that is Mutual Fund Utility, MFU. If you search this thing MFU on Google, you will get ample information and you yourself can get the entire processing done. It is a very fantastic website and gives unbiased opinion about all the factors involved in mutual fund, right from expenses to return. Apart from this, both the exchanges, that is NSE as well as BSE, they offer similar platform by name of NSE Mutual Fund and BSE Star. We can opt either of them. All of them provide the same mutual fund. It is just a matter of convenience, who is convenient and who is quite accustomed with which website. Apart from that, there are multiple apps which are recently coming up like Grow, Paytm, Policy Bazaar, or ET Money. All these are offering direct mutual fund as of now free of cost. But we never know whether they in future will push their PMS services, or for that matter, they have some hidden charges which are not known right now. So ideally speaking, one should opt for mutual fund MFU website. That is the most unbiased site, and it will definitely help everyone to get a online platform. Before opening a direct mutual fund, what we need is KYC. For KYC, we need routine documents like PAN, Aadhaar, internet banking activated bank account. With this basic details, we can get a mutual fund, direct mutual fund activated right from our home. That's all from my side.
That is very nice information, Hemant. And if anything is missing, other panelists, if want to add their comments, they're welcome.
I have a question for Dr. Hemant.
Yes, sir.
Can foreign citizens of Indian origin, like an Indian person, we have orthopedic colleagues who are now American or UK citizens, but they originated in India and held an Indian passport few years back. Can they invest in Indian mutual funds?
Sir, to the best of my knowledge, till the time they hold valid Indian citizenship, that is, till the time they are able to have their KYC done in India, they can hold mutual fund units, but provided they are investing in Indian currency. They cannot directly invest via their foreign currency. They have to have a local account which will be linked to their KYC, and from that account they can have their mutual funds.
I wish
Yes,
to add
Prashant, please
something.
continue.
I wish to add something with Hemant sir. He has perfectly told that MFU utility. I am the dead fan of MFU utility because nowadays they have added one more facility called as a scheduled purchase plan. It's a scheduled investment plan. We know they have added. Hello, you get my
Yes,
Yes,
we
voice?
yes,
can
yes.
hear
You are
you.
audible.
They have added Hemant sir might be knowing it. It is SPP, SIP ke jagah SPP.
SPP.
It is scheduled purchase plan. They have added something like a SIP of daily. There too much versatility nowadays. The MF utility is fantastic for any new person. Also, it's very simple. You can have e-can done online, totally online, and too many facilities in a single password, single click.
Do they have
Thank you.
mobile app as well?
Yes, yes. In the
Yes, yes.
name of
They
Go
do
MF.
provide.
Yes,
That is
The
fantastic.
What's the mobile app? Which is the mobile app?
Go MF. GOMF.
OMF.
Go MF. Yes.
the only problem with MFUI is you cannot generate a statement of the mutual fund. You can know the holding, the
Yes,
value that you invested, and the total value as of today,
yes, yes,
but it does not allow you to generate a statement of the account
yes,
in any way.
yes,
That's, I think, a very big limitation. Otherwise, it would have become an all-in-one app.
yes, yes. They will add probably. I don't know.
Okay.
We
So
can
we'll,
anytime have a CAMS statement which will plot all your investment in single place. So for this minor logistic issue, I think we should not discredit MUSU.
No, I'm just saying that it's
Yes, yes, I
it
totally
it's
takes-
one
agree, sir. I
limitation.
agree
I
with
think
you.
we can mail them and they may be able
Yes,
to
yes,
add
yes.
this feature in future.
yeah.
Yes, yes. Please, Prashant, proceed with next question.
Okay. So next common question is how to select mutual fund if we have 2 or 3 funds of same category. This is very common question. People ask that I have 2-3 listed funds from one category like large cap, small cap, mid cap or something. So how to select best from those 3? So I will direct this question to Bhagli sir and he will give us guidance on this topic.
I would like to share my screen here.
Sure sir. I will stop sharing. You can start sharing your screen now.
See, first thing, let me make it very clear. I personally myself hardly invest anything in mutual funds because I personally feel that I am good at direct equity. So basically, I am a fundamental investor in the stock market with all my holdings in direct equity. But for my daughters who are novices, they have begun their career in investment recently. For them, I have read a lot about mutual funds and I have trained them in doing mutual funds directly themselves. So what we understand of mutual funds is pooled money from many investors where the fund managers invest that money prudently in various instruments. Those who are prepared to take risk and their horizon is long, they park their money in equity oriented funds. But those who want safety and less volatility and their horizon is short would put their money in pure debt funds. Similarly, some who want partly they are prepared to take risk and more of safety, then they will look for balanced funds. Those who want to save on expenses of managing the funds will invest their money in index funds. And those who are really adventurous and want to see outside world and park their money outside India would definitely go in for putting some amount in overseas equity fund. So there are various types of mutual funds. We know they are by structure or they are by duration and they are by asset type as well. So by structure we mean funds which have a definitive end period, close-ended funds. Those will run perpetually. They have no ending limit, open-ended fund, and there are some short intermediate duration funds known as interval funds. And by asset type, there can be pure debt funds, they can be hybrid debt and equity funds, there can be money market funds and only purely equity funds. Then there are various other diversions like diversified funds, tax saving funds, index funds, and sectoral funds. Sectoral funds will park your money in only say technology or pharma or healthcare or real estate or financial services. So sectoral funds will carry more risk, but then one has to choose which funds they want to invest in, looking at the overall investment scenario and the market conditions. So this is a simple graph which will show you risk and reward. The returns in large cap funds will be lesser, but the risk also will be lesser because they are more stable, less volatile. Multi-cap fund will be a little more risky, but return will also be more. Mid-cap and small cap, of course, they will give you more returns, but they will be more risky as well. Debt funds we already talked, they are much less risky than the equity funds, and their minimum holding periods in debt funds is going to be at least 20% to 20% long-term capital gains will be applicable only after holding the debt funds for more than 3 years. Now there are liquid funds of shorter term durations. Instead of parking your money in fixed deposits or savings account, they will give you better returns in liquid funds. Gilt funds are the government security funds which are safer, which give decent returns. And then you have short term and long term funds. Now this is the most important part of my talk. How to select a fund amongst the various options you have available. Category of the fund. In what category you want to park your money? Large cap, mid cap, or small cap? Large cap funds have huge market capitalization. That's why they are stable. They are less volatile, but they will of course give you less return. Second choice depends on the age of the fund. How old is the fund? If the fund is more than 3 years, 5 years, or 10 years old, it is safer because you know the track history of that particular fund, and all this information is readily available on a site like Value Research. Then how much assets under management that fund has. It depends on the efficiency and the expertise and reputation of the fund manager who is managing that fund. Anything which is more than 3,000 or 4,000 crores is safer, and funds with less than 1,000 crores under management are always, more risky because we do not hardly have options or choice to rotate the portfolio and shift your investments. Then one has to study the return to the investor by that particular fund in last 3 to 5 years. That's all again readily available. Expense ratio, how much that asset management company who is running the fund charges you for managing this particular fund. So amongst all the comparable funds, one with the lesser expense ratio is naturally people will look for. Profile of the fund manager, you have to do a lot of research on who is managing the fund, what other funds he has managed, what is his past history, and how was the performance of the funds where he has managed. Because these funds managers also tend to shift their employers, they shift from one company to the other, and if you track the history on Google and you find their previous funds managed by them, then it will be safer for you. Analysis of holding, that means the fund which you want to invest in, you study the portfolio, you study what holding that particular fund has. If it strikes you, yes, this fund is holding the best shares amongst that category, then you can go ahead with, and this analysis of holding or the details of the portfolio are readily available on net. And this is the most important thing which common investor does not know. Risk adjusted returns. How much risk are you really taking to beat the returns from average investment? There are various criteria, various parameters, alpha, beta, standard deviation, and Sharpe's ratio. And where do you get this information? That's what I'm going to talk about. Standard deviation is a tool that measures deviation or dispersion of the fund portfolio from the expected return. If fund has a standard deviation of 7% and the average return is 15%, that means the fund has a tendency to vary from 8 to 22%. More the standard deviation, more is the variation in the returns. Less the standard deviation, less is the variation in the return. So that's a simple thing one has to remember. The standard deviation of the fund. Next is Sharpe's ratio. It measures the risk adjusted returns of the fund. It measures extra return your fund is giving above the returns generated by a risk-free asset like a government bond or a FD. So what is Sharpe's ratio? It is a fund return minus the risk-free return. Your fund is giving 12% return, and if the risk-free return is giving you only 6%, divided by the standard deviation of the fund returns. It always used to compare with the peers in the same category. Absolute value of Sharpe ratio has less meaning. Once you open a site like Value Research and compare the Sharpe ratio of all other funds in the same category, one with the highest Sharpe ratio is better. So risk adjusted return is measured. One of the tools is Sharpe's ratio. Higher the Sharpe ratio, better the risk adjusted return for your mutual fund portfolio. Next is alpha. Measures excess returns that your fund has generated as compared to the benchmark index. So any category of fund you select will have a certain benchmark index, and alpha 5 of 5 means your fund has outperformed the benchmark index by 5%. If your benchmark index has given you a return of 15%, and if your index is giving you 5% more return, then this is known as alpha of 5. A negative alpha value shows that returns of the fund, they are lagging behind the benchmark. So naturally everyone would like to have higher alpha. What is beta? Beta is the volatility measure, again like standard deviation. This denotes the sensitivity of the fund. You know what is the beta of a share. If your index moves by 10% and the share which you have chosen moves only by 5%, that means it's more stable. Its beta value is less than the index. Similarly, here also a beta of less than 1 shows the stability of the fund, which is better than the benchmark index. So this was about how to select a fund. Now, where do you get this information? Let me share. I think I have lost that.
Morningstar.
You can take the further question.
So there are two tabs open in your window. You can check them at top. Yes.
I'm not able to see it here.
Okay, you can tell the names of those websites.
I will show you how to do it actually.
Okay, okay.
You
You can stop sharing the screen and
can stop sharing and
Yeah.
start reshare again. Then we
Yeah.
can.
Hemant, would you like to add something to this discussion?
Apart from what Dr. Bhagli has mentioned, there is something called as Sortino ratios. It is just a refined form of Sharpe's ratio, but the basic difference is in Sharpe's ratio, it considers standard deviation on both the sides, on positive as well as in negative side. But in Sortino, we only consider it on the negative side. So it gives more better result. Calculation part is a bit tedious. Ready-made Sortino ratio is available everywhere. So its reading is important. More the Sortino ratio, more stable, more return the mutual fund will offer.
Okay, so higher the Sortino ratio, better the fund is.
Yes.
Okay, okay. Vishwas sir, do you want to add anything to it? You have to unmute yourself first. Vishwas sir, you have to unmute.
Yes. Now
Yes.
is it
Yes, yes, you are audible.
okay? Actually, I choose the fund by fund houses, and then I see the things this alpha and beta, because some I don't know the experienced people that some mutual fund like Quant, they have come, all their ratios and everything is too high. I don't know whether what is going wrong or right. So that's very new. So only going by that alpha, beta, and Sharpe ratio will be dangerous, is it?
So Bhagli sir has already said that he first goes for age of the fund. He looks for 3
Yes,
years, 5 years, 10 years. And
yes, yes,
after that criteria, filtration criteria, all these things will be looked after. Bhagli sir, do
yes,
you
yes.
want to share your screen again?
Yeah, but I'm not able to get it. Actually I have opened value research and I wanted to show you that. Are you able to see my screen?
No,
No,
no.
sir,
You
you have
have to
not
share the
shared your
screen.
screen.
Okay.
Share the screen, it will be seen. Click on share screen.
Yeah.
You can see the
Yeah.
browser also in your options.
Yeah. Can you see it now?
Yes.
Yes,
Yeah.
yes.
Now, once you go to the site of value research, you go down to the bottom in the fund category, you select, now this is a menu you get. For example, equity large cap you want to hunt for. Go and click on the equity large cap funds. It will give you lot of information now. Look at this site. Now you have so many funds there. ABSL, Aditya Birla, Focused Equity, Aditya Birla, Frontline Equity, Axis Blue Chip. Now look at the column here. Then in this column, on the left, you have got the details of the names of the funds. Then whatever area you want to focus on, whether you want to see the returns, whether you want to see the portfolio, whether you want to do the risk statistics, whether you want to know the NAV details and your fees and details, all these things are displayed. Now, if you see, this is a script. This is the fund with a 5-star rating. This is Axis Blue Chip Direct, which is one of the most important and most popular large cap funds ever. Look at the details of this. Now, rating is 5-star. Equity large cap. It was launched in January 13. So that means it is 8 years old fund. Its expense ratio is only 0.5%, which is really negligible. Its 1 year return is 54%. Its 1 year rank, though it's down at 65.67. So last 1 year, it has not really done better as compared to other funds in the same category. And net assets under management is 25,183 crores. That's a huge corpus. So look at all this information in one stroke. Axis Blue Chip is managing 25,000 crores against Aditya Birla ABSL Frontline Equity is managing around 20,000 crores. But it is doing much better as far as 1 year performance is concerned. Now, if you want to see the returns over the years, go there and click on the returns. It will give you annual return, quarterly return, monthly return, and weekly return. So That's how you will come to know how your share fund performance is over last 1 year or fractions of it. Similarly, you can go to the risk statistics, and whatever I had talked about recently, you will see it here now. Fund return grade high, riskometer high, standard deviation is 18.18, which is as compared to its peers, you can compare, it's lesser. Sharpage ratio is 0.63, which is better than almost all what you are seeing on the screen right now. Sortiner ratio, as my colleague has already talked about, beta is 0.78, so it's more stable than the index. Alpha is 4.53, which is reasonably good. There is one more fund I can see below, which is alpha of 4.9, and that's Canara Robeco Blue Chip Equity Fund, and R squared. I don't follow R squared. What I normally see is standard deviation and Sharpe ratio, and this is the stat which we get, and you can always compare the returns for your precise decision. So this is how you can go to the site of Value Research and do your own study in various categories of fund which is listed on the left side, and do your own study, select the fund. Every Sunday, Business Line or Monday's Investor Guide of Economic Times, they give you detailed information of star rated funds. You can pick up fund from there and feed the information on either Morningstar or Value Research, and do your own homework and select the best possible fund you need to. It depends on your risk appetite as well. That's it.
Sir, one more thing. Can you click on any one fund?
Just a minute. Now I have come to another very important aspect, and that is the risk statistics. We have just seen Axis Blue Chip Fund. Now this is Morningstar website which I have opened. Axis Blue Chip Direct Growth Plan. Right? You come down on the site. Now, if you see the screen, you have a risk and rating. Are you able to see it?
Yes, sir.
Risk and rating. This is the most beautiful chart, and I really love this from Morningstar. Now you can see the fund which we have selected is Axis Blue Chip Direct Plan, the fund which we have already seen on Value Research as one of the best performing large cap funds. Now look at this chart. This is the benchmark index which is at the center. This is the y-axis, this is the x-axis. X-axis is giving you standard deviation, y-axis is showing you the returns. Now what you want your fund to do, it should be less volatile and it should give you more return. So if you see this fund, this is benchmark which is at the center of the standard deviation and center of the return. All other funds, if you simply compare in this category, they are giving you more standard deviation than this fund which we have selected, Axis Blue Chip. You see, this is your return, this is your volatility. So Axis Blue Chip fund is less volatile than the index itself and all other funds put together in the category. Can you see that? So Axis Blue Chip fund is less volatile and it is giving you more return as compared to index as well as all other funds in the category. So this is how you should derive at your own study, compare it with the index, compare with the other funds in the category and see the performance as of your selected fund. So ideally, if you divide this chart into 4 quarters, your fund should be on the left upper quadrant for giving you better returns and less volatility. If it moves to the right, it's more volatile. If it moves to the left, it's less volatile. If it moves up, it gives you better return, it gives you lesser return. So you do select a fund from Investor's Guide on Economic Times or Business Line, then study it on Value Research site, and then put it on Morningstar for risk analysis. So you get all the information like age of the fund, corpus of the fund, returns in 1 year, 3 years, or 10 years, and its risk analysis and its chart. That's how I have trained my daughters to select fund. Thank you.
Fantastic.
Sir, the value research website, please. Yeah, value research website.
Yeah.
This open
Now
any
I'm
one
here.
fund. We'd like to see the peer comparison. There is one chart of peer comparison. So if we scroll down, so this is peer
Peer
comparison
comparison.
chart.
See. Yeah. This is a peer comparison chart. Launch date, 1 year return, 3 year return, 5 year returns, expense ratio, and assets under management. So it gives you direct information. So once you select you sit with a pen and pencil, spot down 3 or 4 funds from each category, and do this individual analysis on Value Research and Morningstar, and come to a final conclusion. That's how you should do your fund investment.
Thank you, sir. That was very valuable information.
Yes.
Harpal sir, do you want to add anything to this?
Yeah, in this peer comparison, if we look at the screen, look at the UTI Nifty Index Fund. I'm a kind of purist when it comes to mutual fund investments. There's hardly any difference in the return. Rather, in 1 year return, it is beating the fund Axis Blue Chip. 3 year return, 5 year return. But look at the expense ratio. And here you are directly in the index itself.
But here,
The
3-year and
expense ratio is
5-year
almost
return
1/3.
of Axis and Canara is way higher.
No, not with Canara. Yeah, but then that comes with the risk also. You compare the standard deviation with the UTI Nifty. As I disclosed, I'm kind of purist.
Yes, yes.
So if it comes to mutual funds, I think it's better to go with the index. And by chance, this chart has come up. So that's the reason I came on to it. Index funds over the years will any day beat. If you look at the 10-year chart or 15-year chart or 20-year chart, no mutual fund has been able to beat the index in the long term.
Okay.
Because today we don't know. We know the Axis Bank has been very good performing thing. But there was a clear-cut disclosure by Dr. Bhagli also that when he looked at it, a very good fund, the performance now is 65 by 67 out of the category.
Yeah, that's right.
So how do you predict for the future?
This fund I have not recommended actually.
Oh no,
Just
sir,
pick it up from the list. I don't put anyway in mutual
no,
funds.
sir, I'm
But
saying just taking it as an example.
Right.
Yeah. So, the point is, अगर हमको गोल्ड स्टैंडर्ड ही खरीदना है तो गोल्ड ही क्यों नहीं खरीदते हम लोग? If everything is to be compared with Nifty, then why not buy Nifty?
Yeah, that is
Valid
good
point,
view
sir.
for low risk. Hemant, do
Yeah.
you want to add?
No, I totally agree with Dr. Harpal, sir. I agree with him that Nifty in long run will definitely beat all the mutual fund houses, provided your time duration is long. Yes.
Okay. We'll move to next question. Bhagli sir, can you stop sharing your screen?
Yeah.
At the bottom. Okay. So next question usually asked is how many mutual funds should we have in one category and how many categories should be selected to form our portfolio, like large cap, mid cap, small cap, mixed, hybrid, debt. There are so many categories. So I would like to direct this question to Harpal sir first.
as I already disclosed, I am a kind of a purist. So in my own portfolio, when I do it for my kids or for my family, the way I recommend is go for the index fund, which is easily available, like a Nifty 50 fund and a Nifty Next 50 fund. These are the two will be my core portfolio. They will form the core of my portfolio. But since when we go down to mid cap and small cap or a hybrid fund or a multi cap fund, there the volatility is too much. And some fund may underperform and some might be a sector leader in the coming years. They might be in the top performing bracket. Another 2 years down the line, they might be at the bottom of this thing. So what my personal take is, for a large cap category, I'll choose an index fund, which will be one. If you want to select another one, that's okay, but never more than 2 funds in one category. Because then the point of having mutual funds is defeated. See, mutual fund is already investing in 50, 60 stocks or maybe 100 stocks to form their portfolio. And you buy 2 or 3 funds, large cap, who have a mandate to invest only in large cap. So majority of the portfolio will be duplicated, right?
That's right, sir.
But when it comes to mid cap, if we have an index fund, I would again go for single pure. But since we do not have it in India, a mid cap and a small cap index funds, so I would like to go for at least maximum 2 funds in each category.
Okay, that is good.
Then-
Means for large
Yeah.
cap you select only one, and for mid cap, small cap, 2 funds each.
Yeah,
At the
and the
most.
way I recommend to my friends is, like, for a couple, one could have one small cap fund and the one could have another small cap fund. The other thing I always tell them is spread your portfolio across different fund houses. As it was introduced, I think in your talk, or Dr. Bhagli or Hemant, one of you mentioned कि जो fund managers होते हैं, they keep on jumping from one to another.
Yes.
So you don't know, you invest everything with one fund manager who is managing 2 funds of the same fund houses. They are both your core of your portfolio, and he jumps the ship to another one. You know, you're left in the lurch in the mid-sea. You don't know who the next fund manager is gonna be, right? That's as far as the equity funds are concerned. When it comes to debt funds, it's my personal preference. Again, a disclosure. I'm not contesting if somebody has a different approach. I go only for liquid funds because bond markets keep on changing. And then you can have a really major drawdown if the bond interest rates increase, your fund will really underperform the market. So liquid fund, but I'm not looking at the returns when I go to the debt fund. I will not choose a liquid fund which gives me 7% return rather than a 4% or a 5% return. When I go to a liquid fund, my main reason of investing is I want to be tax efficient over a FD, and my security for my money should be almost as good as an FD.
Okay.
It can never be like a FD. So I'll choose a fund which invests only in sovereign instruments like RBI bonds or RBI T-bills or FDs or instruments of the what we call as domestic important banks like HDFC Bank, ICI Bank, SBI Bank. No, I won't like we saw what happened with the Franklin India debt funds.
Yes.
They had a huge problem and then the people did not get their money back. So I'm very, very focused on that. When it comes to ELSS, I'm again focused not more than 2 funds in ELSS. That's my take on it. I'm very fond of ETFs. I know there are a lot of things said against the ETFs, but in India, there are only 1 or 2 ETFs have good liquidity, have a good corpus, and are well managed. The main problems are tracking error and the liquidity issue. The first is the liquidity, second is the tracking error. But since we are not recommending anything on this platform, so I won't take a name, but one of the ETFs does have a very good tracking error. There's hardly any tracking error and lot of liquidity. You can sell it anytime, you can buy it anytime. My main concern is when I buy a Nifty index fund, which is not a ETF, at 1 o'clock, I decide the market is good. I want to sell off. I have achieved my target. I want to sell off half my mutual fund portfolio. I sell it, and 3 o'clock, the market dips by 400 points. So what my target was achieved is no longer there because the market has dipped. The NAV would have gone down by 3 p.m., but I can't reverse my transaction. Whereas in ETF, nowadays there's hardly any brokerage. There are plans where you don't pay any brokerage. There's hardly any brokerage. I can sell at the price that I want to sell, exactly, and I can buy at the price that I want to buy. And the brokerage platforms do give you the option of SIP. Earlier there was no SIP available on the brokerage platforms. That with the index funds or with the mutual funds, कि पैसा आया, आपकी सैलरी आई या आपकी इनकम आई तो अपने आप से चली गई. There was no emotions involved, but now that is even possible with the broker platforms. So that's my take, and it's open for discussion to the house.
Sir, which ETF you prefer? ETF fund? Which ETF fund you prefer?
My personal choice is Nifty Bees.
Okay.
Again, a purist Nifty index fund.
Okay.
You have liquid Bs for liquid fund.
Yeah.
You have infra Bs. You have junior Bs for junior fund. So these are available, but the best liquidity is with Nifty Bs and liquid Bs.
And bank Bs to somewhat extent.
Bank Bs is also there. Exactly.
Vishwas sir, what is your take on this?
I would something more to add in this fund category. Nowadays, a very good option is available for overseas investment funds.
Yeah, that is
I
good.
had invested in a Franklin US feeder fund, say 7 to 8 years ago. That has given me fantastic returns. And just now, in the last month itself, I had invested in one Mari Asset Fang Plus fund. That is a really high concentration fund in only 10 stocks in a New York stock exchange.
Okay.
But I hope that is going to give a fantastic return. So what is your take on Bagli sir?
Where are these funds
As far as
available?
overseas funds are concerned, we have a dual advantage. If the underlying stock performs well, you get a better return. And secondly, it's the rupee which depreciates against the dollar over the time. That gives us additional advantage. But one thing which has happened of late, which is not good for us, and that is this year alone, after the COVID pandemic, US government has printed currency worth $6 trillion. So the liquidity of dollars has increased so much that the dollar is not likely to improve in next few years. So the gains which we otherwise could have got because of depreciation of rupee against the dollar will not be there anymore. So one has to be more cautious in next 2 to 3 years in investing in US funds.
That is very good analysis, sir.
Yes.
Hemant, do you want to add anything to this?
No. Please continue.
Sure. So we head to our next question. There are many people who ask us that if I get lump sum amount, for example, by sale of property, etc., then should I invest lump sum amount or should I do SIP for this? So Vishwas sir, I will direct this question to you.
Yes. Best thing, if you get a lump sum amount by any windfall like property sale and all, we get a little bit hurry, right? We are advised by these and these friends to invest it faster, so to get the returns earlier. But I would say when you get this lump sum amount, just be patient. I will invest this lump sum amount in at least debt fund or liquid fund, and then I will wait for market. I will study it from my perspective, and like Bagli said, and I will invest some part of that lump sum amount in some good fund. Then what it is said, it after like SIP, not per SIP, but after some time, you do invest from that lump sum amount, a partial amount in a spread of a time, so that you will get the little much more return than investing at the same time, investing at the first time itself. So I will put the money into liquid fund or debt fund, you can say, and I will liquidate or I will transfer to some good fund over the time of period. Say when I feel that the market is down, I will add to something. And not only this, the SIPs I have started with some goal. Say I have started the SIP for my kids' education for 10 years. I can add that lump sum amount in that SIPs also. That is also one good thing, because investing some lump sum amount in the going on the SIPs is going to gain you a much more return. So I do not put the all the sum in a one or two fund on the day one itself. I will wait. I will put in a debt fund or liquid fund.
So you will go for smart approach and wait for market corrections to invest more,
Yes.
like
Yes.
pyramid buying.
Yes. Yes.
So Hemant, do you want to add anything to this?
Yes, what Sir has mentioned is right, and it is actually speaking the ideal thing to be done. But more so, you need a more of tracking of market. You need to be active in market. You need to know the micro and macroeconomic structure, which will help you to decide the trend of market. So, if I would suggest, if someone is not having this much ability or is not that much interested for mutual funds or for that matter tracking the market, lump sum deposit is advisable. If at all he does not take any efforts to track the market, then lump sum जहाँ से जितना पैसा आया उतना तुरंत इन्वेस्ट कर दिया, provided he does not require that much amount of liquidity in near future.
Bhagli sir,
तुरंत
what
करने
is your
में-
take
This
on
is
this?
totally for passive person, not
Yes.
for active person. This is for passive.
Yes.
So that time, as Arpal sir said, you put in a Nifty index itself.
Yes, yes, that can be done. Yes.
So, Bhagli sir, what is your take on this?
Yes, I agree. If you want to really put money lump sum, then it is better to put in an index fund, because if you study the returns on the index over a long time, it will always do well. And secondly, the shares which comprise the index, they keep on changing over the time. The less popular and less transacted shares or shares with lesser market capitalization are thrown out of the index and the new shares come in. So you will always get a decent return from index shares. So those who are not very active in the stock market, those who do not trace the indices very regularly, and if they have a lump sum amount, then it is better to keep it in an index fund. And if you feel that, well, banking sector is going to do well because the economy is growing and all financial services sector is going to do well, then you can put money in bank Nifty, bank Bs. Otherwise, you can just put in general index like Nifty. Another very important study which has come up recently, we only concentrate on Nifty 50 shares, but Nifty Next 50 is another sector which is giving better results in last 3 years. So it is worth considering that. L&T, Kotak, they have come out with the funds which invest money in the next 50 best shares in the Nifty. They are all large cap shares and they are doing exceedingly well. In fact, they have done better than the Nifty 50. So it is worth considering to put money in Nifty Next 50.
Yes.
That is very good idea.
Hmm.
Harpal sir, do you want to add anything?
Yeah. So my take is, when you get a lump sum money, and that's what I practice, I would put that money first into a liquid fund state of, so that I have peace of mind. And then depending on the PE or the market outlook, I would either do a lump sum investment, which might be in tranches, or I'll go for a SIP. Because if you at the top of the market and you end up putting something like from a sale of property, which by Indian standard is considered as gold. Reality mein लोगों ने, कुछ जनरेशन के लोगों ने कभी फॉल होती देखी नहीं है. And if the money is coming from a sale of a real estate and you put it at the top of the market and market corrects by 30%, the whole household is gonna be after your life. कि घर बेच के पैसा 1/3 कर दिया, क्या किया तुमने स्टॉक मार्केट में लगा के. And
That's
that
so
is
true.
the real situation, you know, because all of us who are very active in the market, ये सबको सुनने को मिला होता है कि स्टॉक मार्केट तो सट्टा है बॉस, कुछ नहीं होता है इसमें. और म्यूचुअल फंड में ले दे के यार एंड में एफडी का ही रेट मिलता है, कोई फर्क नहीं पड़ता. That's what we get to hear.
Yes.
So I would always, I'm a very conservative and very patient as far as my investments are concerned, really concerned where my money goes, how my money goes. So I would deal with it that way. I always look at the market PE. If the Nifty PE is really low, I would put the whole thing into it. If the PE is moderate, I might go in tranches. If the PE is very high like these days and the market is really hot, but still we are looking at 16,000 if we talk today,
Yes.
I would still put some money into the market and slowly over a period of time, keep on increasing my exposure to equity from that money.
Okay, sir. So our experts have said that if somebody has good knowledge about market and cycles, then he should invest immediately in some liquid fund and wait for opportunities to invest in appropriate funds. And if somebody is not so well versed with market cycles and novice investors or passive investors, they should directly go for Nifty Bs or some exchange traded funds, Nifty 50 and next 50. That is ideal. We'll go for next question now. Many people nowadays are aware about direct funds, and initially, since regular funds were available, they may be having regular funds since 10-20 years. So now questions are arising that whether we should stop those regular funds and change to new direct funds and invest all the old money from regular to direct, or should we stop that and keep that money in regular funds and start new direct funds, investing in start new funds. So what are tax liabilities involved in this? Vishwas sir, I would like to answer this
Yes.
first.
There is no other answer than to stop the regular mutual fund. There is no question, no, not at all. Because the first slides itself, you have shown it is a just difference of 1% or 1.5% makes going to make a lot of difference if you go on the same regular fund for a time period, right? So
Yes.
there is no question, you have to change it. So you can change it to the direct fund. Either you can switch to the same fund in the category change from regular to direct on the mutual fund utility portfolio, that website, or the website of that mutual fund itself, or you can fill up the form and send to the CAMS or Karvi. They will do it after 4 working days, but there is no question in it, right? Then makes the difference. Yes, definitely 1%. Why are you wasting it, that 1% of your hard-earned money just to changing over, just the reluctancy from changing over from regular to direct? What is the problem with you? You have to save the money. You have to increase the money. There is no way. Only thing, once you change that switch from regular to direct, the other day definitely your agent will call you. What has happened? Why you done it? Right? So you have to answer that your agent boldly that yes, I have done it. Tax liabilities, whatever you do from switch or redeem, there is a calculation of tax. Even though you switch from regular to directly, see, it is taken for a tax liability, taken is as a redemption. So you have to pay the tax accordingly, and the switching over from regular to direct for taxation, it is a purchasing at a new purchasing of a newer fund itself. So you have to pay the tax on the redemption of a regular fund, but you have to do it.
Is
Whatever.
there indexation?
Yes, indexation is available for the equities. You know that grandfathering has been done for 31st of January 2018. They have done that grandfathering, that fair value is calculated for that day. and after that, for the long-term capital gain tax, you will get little bit less of the tax, and for debt fund, your regular indexation. So for equity funds, you get some benefit of that grandfathering of the fund clause, right?
Yes. So how can we convert regular mutual fund to direct fund?
You can do it on websites of
Utility
the
or their
yes,
website.
MF Utility or direct websites of the funds, or fill up the form.
Okay. And if we have regular fund which we have stopped SIP, and
Yes.
it is still a regular fund, we are not investing new money,
Yes,
and if we keep that same way for 5 years, so
yes,
will it have less returns than direct fund?
definitely,
Okay.
because
Means,
that
and that expense ratio will
yes, yes, total expense ratio is much more higher. No?
yes.
One at almost 2 to 2.5% more
So just
for a
stopping
regular.
regular fund is not the answer. We have to shift to direct
Yes,
fund.
yes,
Even old
definitely.
thing should be converted to direct fund.
Yes, yes,
Okay.
definitely.
Thank you. That was quite informative. And now we'll go for question and answer session. I'll
Yes.
see if there are some questions.
Can I add one thing?
Yeah, sure.
Yes,
Yes. See, supposingly in case a person is investing in market via mutual fund, regular mutual fund since the level of 8,000.
Okay.
yes,
Okay. And since it was a regular fund, now we have reached a level of 15,000. So he has gathered a compounding effect of almost 50%,
yes,
more or less 50%. So whenever he decides to stop the regular fund, he is supposed to put the entire money on the same day in direct fund.
yes,
This way, he will keep the compounding factor with him, and the only losing part will be the expense ratio.
yes,
So, with reference to previous discussion, lump sum investment is advisable for conversion from regular to direct fund.
Yes.
definitely.
And how many days does it take usually for when we stop a regular fund and redeem it? How many does it
It is
take days does it
it
take?
is four working days, they say.
4 working days. So anyways, market will be moving. We cannot
Yes.
shift it immediately.
No,
Yes.
no, no. This is a different thing. The money never comes to your account when you switch
Okay.
from regular to the direct of the same fund or the same fund house.
Ha.
The money will never come to your account. The money will be switched in-house on the same day.
Okay.
Yeah.
So that will be immediate with immediate
Yeah.
effect.
So the NAV of, say, if we had given a request for switch 3 days back, and today was the day to be done. So 3 o'clock NAV for fund A, which was regular, and 3 o'clock NAV for the fund B, which is now direct. The money will get transferred on the same multiplication and division factor.
Okay.
What will be the tax consideration? Switching from regular to direct after 2 days, 3 days, or on the same day, how does it matter
Doesn't
tax-wise?
matter in the taxation, but it matters in the NAV.
Yeah.
Tax, you will have to deposit tax from your own money lying in your bank account.
Yes, that is right. Yes. NAV will change. And
Yeah.
for suppose somebody has 10 CR worth of portfolio and NAV changes by just 0.5%, then even that will be big amount.
Yeah.
And there is one question from Dr. Amit Patil. How to select the time for which to continue SIP in a fund? For example, 4 or 5 years. How to select the duration? That is his question. What should be
Directly
minimum
question.
duration for fund investment in mutual funds? And
So
Uh,
I'll take this question. The
Okay.
first thing is, Dr. Amit, you have to be sure why you are investing into the mutual fund. What is your target to achieve? The investment is always target based. Like you could have a target of your child's education, your child's higher education, marriage of your child, or your retirement portfolio. Any investment into the equity should be for long duration. And when we talk of long duration in an equity fund, is minimum 7 years. The reason for this is the economic cycle is of 7 years, plus minus 1 year or 2 years. So we should never invest in equity the money that we might need in less than 5 years. Never less than 5 years, ideally 7 years. But again, that doesn't mean that we will take the money out after 7 years. The investment in a portfolio has to be target based. Say if you are saving and investing the money for your child's higher education, and you know the fee today is about, say, for MD medicine is 1 CR for 3-year course. Your child goes to the MD medicine after 5 years, and you expect the fee will be 1.5 CR by that time. So you have to decide your SIP that you get a target of 1.5 CR after 7 years or 8 years. If your child's MD is 10 years away, I like to achieve the target 2 years before, so that the market downturn or upturn is not does not affect the outcome of my portfolio. And if my child's MD is 3 or 4 or 5 years down the line, I would not put that money into equity. I put the money now when the Nifty is 15,400, and in 3 years down the line or 4 years down the line, it is at 14,000. I've actually lost money. And it's such an important thing in life. If he secures a good rank and I don't have the money to pay, his career is in jeopardy, right?
Yes.
So it has to be for long term, minimum 7 years. Try to achieve your target for what you are investing at least 1 year, ideally 2 years before that target.
That is very good opinion. Bagli sir, do you want to add anything to it?
No.
Okay. There is one more question. Dr. Rahul is asking, when market is high like now, is it right time to invest in mutual funds? Does it matter? This is very good question. Vishwas sir, do you like to answer this?
No, this question is good for Bagli sir.
Bagli sir is... Yeah.
See,
Bagli sir,
basically, see, the opportunities always exist in the market. Market may be, very high also. It really hardly matters because opportunities always exist in the market. And the fund managers are smart enough to spot the right opportunities. Secondly, what is the difference between an individual investor and investment through a mutual fund? Let us all understand. If I keep on switching my shares all the time, I will be taxed at either short-term capital gain or some income tax assessing officer may, label me as a trader and he will charge me as a business income. So my tax outgo will be much higher if I keep on switching my shares individually. But for a fund, there is no short-term or long-term capital gain tax. A fund manager can churn his portfolio n number of times he wants. So that's one more advantage. Putting money in the share market through the mutual fund route, unless you sell your units, you don't have to pay any income tax or capital gains tax, right? So always remember that tax liability per se through mutual fund route, even in equity, is lesser through the mutual fund route than the individual investor. So even if there are ups and downs in the stock market, you have to rely on the smartness and decision making of your fund manager. And since opportunities will always exist in the market, you are not going to lose very heavily. So never be scared कि अब मैं क्या करूं, बहुत इंडेक्स ऊपर गया है और अगर मैंने पैसा डाला और इंडेक्स नीचे आया तो मेरा पैसा डूब जाएगा. It will never sink. You have to be cautious. Don't put all your eggs in a basket at one time. Put them gradually.
Okay, sir. There is one very interesting question. Just a minute. Dr. Sandeep Jain is asking, he has 30 different mutual funds and all are regular. So he wants to know, does it make more sense if he sells them and invest the proceeds in few good funds, direct funds, or should he shift all 30 regular funds to 30 direct funds?
No.
Vishwas sir?
Yes, the 30 is too much to track. And as Bagli sir said, or Patil sir said, you choose one or two from each and shift to the direct. keeping the 30 funds so of the same category in your portfolio makes no difference, makes no sense.
So portfolio should be smaller in
Yes,
mutual funds, not 30 funds.
and change auto direct. There's no question.
Yes. Many people are still not clear about how to switch from regular to direct. Vishwas sir, can you give some details?
Yes, if you are on the website of the direct fund, there you can have a choice of transfer or switch like that, right? On the portals like MF Utilities, there is a single click for the switching. So from the regular, you can switch to direct. There is no other way, right? On the website, you can do it, or if you are not well versed with the websites, you can fill up the form and send to CAMS or Karvi.
Yes. So online can be done from fund house websites, or offline can be done through CAMS or Carvi. It is
Yes.
very simple option.
Yes.
It's not too difficult.
Yes. Only thing, be ready with your agent to call back in an angry tone. He will
Yes.
call you. He will call you next day.
So there was one question that if we have taken a mutual fund from a agent, is it possible to shift to directly without involving the agent? So that is the
Yes.
answer for this question. That we
Yes,
can
it's
do
possible.
it ourselves. Agent is not required to shift.
Yes.
One more question I have from Dr. Hemant. I have my funds in ICICI Direct and they have only regular funds. So how can I shift to direct fund? How can all direct funds be tracked by me on my nominee? He has
Yes, sir.
ICICI Direct funds. He wants
Yes,
to
sir.
know how
Harpal sir,
can
you
I
want to
shift
say
to direct
something?
fund. Only regular funds are available on ICICI Direct.
Dr. Prashant, the reason is ICI Direct is a platform
Yes.
and they will not give him direct fund because then they lose out on their commission. So the only way is that he should liquidate his portfolio from the ICI Direct, which is a platform owned by ICI Securities,
Okay.
and he should go through MFUI as everybody has explained.
Okay. So can
Absolutely.
he change that from MF utility? Can he see his funds in MF utility also?
Yes.
Of course, he will be able to see. If the holding pattern is the same as when he registers, he'll see his funds.
Okay. So even if he has his funds in with ICICI Direct, if he opens his account in MF utility, he will be able to see the funds and shift to direct fund himself.
Yes. Yes.
Okay.
If the investment is through same PAN number, if
Yes.
he's holding multiple PANs, like say for HUF, for wife, for son, for father, mother, then the tracking will be difficult. If there is single PAN, then it all will be tracked.
Okay. So PAN number is important.
Yes.
And holding pattern also, because for each other holding pattern, you need to have other CAN number.
Okay.
Yes.
Means if you are having joint account, you have to have a separate CAN. For your own, you have to have separate CAN.
So for any reason, if it is not possible to convert through MF utility or other platform, the alternate option is to sell it and then reinvest in direct fund.
Yes.
Yes.
That will be easier if somebody is not able to do it.
Okay.
Yeah, and one thing that you said, somebody was saying, asked you, that if they have done the investment through the advisor, is it possible that they cannot shift to direct funds? I know a friend of mine who had a problem because his advisor had given his own mobile number as the contact number in the portfolio.
Okay.
And all the OTP that were generating were going to the advisor rather than to him. And then, like Dr. Vishwas said, next day he was like, why you want to shift? These are such good funds. And my friend called me up कि वो तो मेरे को ऐसा समझा रहा है, ये कर रहा है. मैंने कहा उसको बोल मेरे से बात करे. So then I had to be clear cut in black and white.
Yes.
The last thing that was left was calling names. I told him that I'll file a police complaint against you if you don't do it.
Yeah.
Because you have cheated, and I'll report it to the SEBI and others that you have given your own personal mobile in the client's name. So then he agreed कि ठीक है जी मैं फॉर्म साइन करवा के ले जाऊंगा और मैं करूंगा. So some of them who are smart enough, they play these kind of gimmicks.
Yes.
So that is why it is important that when you sign a KYC form, don't sign on the blank form. Even if the person is from the bank, tell them, this is my card, this is my PAN number, this is my Aadhaar. Please fill up the form, sit in the next office to mine, fill up the whole form, get it to me and sign it. In the initial part of the years when I started with the mutual funds, it happened with me also. You know, my name is Selly and my email was hselly@gmail.com. And that guy filled up dselly@gmail.com. And the mutual fund house said, we will change your email. That's not a problem. But when it comes to redemption and other things, the dselly@gmail.com will be considered as default email
Okay.
because that is the original one that you filled up. At that time, there was no KYC or anything.
Mm-hmm.
So then I had to bear the exit load. तो मैं पैसा ही उससे निकाल के फिर दोबारा से इन्वेस्ट किया. वो फोलियो बंद करना पड़ा मेरे.
Okay.
So they do play these kind of pranks. So one has to be careful. It's your money, hard-earned money. Be careful with it.
There is one question from Dr. Rajesh, and he is asking about equity funds. If the goal of equity funds is achieved in terms of returns or time duration, so he wants to know whether he should shift all the equity funds to debt funds. I think all equity funds goal will not be achieved at same time.
If one portfolio with a clear-cut target, my goal is achieved, I would shift the money to a liquid fund, definitely, or to FD.
Okay.
I won't take a risk with the market. Never.
Dr. VC is asking, if I am actively involved directly in equity, should I also invest in mutual fund? Bagli sir, would you like to answer this question? The person is actively involved in direct equity and he wants to know whether he should invest in mutual funds.
As I told you, if you lose interest and if you are professionally too busy, or for some reasons you are not able to trace and follow the market every day, then it is better to go through mutual fund route. Because if you have invested very heavily in the equity markets, you have to be very vigilant and you have to really keep a watch on what's happening to your investment. Though you may not change the decision every day, you have to be watchful. And if you want to be less watchful, you can go through the route of mutual funds.
Okay, sir. Dr. Asit is asking a question. What is opinion on Bitcoin and cryptocurrency? This is not part of discussion for mutual funds. But Bagli sir, you have invested in Bitcoin. Would you like to answer?
I have lost very heavily in Bitcoin and then it was made illegal by the government of India. Though Supreme Court has given some relief, I am not too sure, but I will not invest in Bitcoins for the simple reason that it is not supported by any central bank or any government. So any currency, for it to be valid, it has to be supported by some central banking or financial institution. What is supporting Bitcoins? It's just a chain of computers. So, if you see the volatility in Bitcoins, one day company says we'll accept your currency in Bitcoins. Ultimately, what are you buying Bitcoins from? Your own currency. So you are exchanging your own currency to buy something which is not supported by any regulatory authority.
Yes.
Well, it's a dangerous game.
It's gamble.
Yeah.
Dr. Sandeep Jain is asking, what is the tax liability if I shift from regular to direct? Vishwas sir, would you like to answer?
So if you do any transaction like switch also, for tax liability, it is taken as it is redempted or sold. Then you have to pay the tax upon it, whatever with long term or short term. And the new fund or switched fund is taken as a purchase on that day. So you have to pay the tax.
Okay.
So just adding to it, Dr. Sandeep, he's the one who asked question, right? Dr.
Yes,
Sandeep,
yes.
Death and tax is inevitable. वो आपको आज भी देना है. आप 5 साल बाद विड्रॉ करोगे तब भी देना पड़ेगा. लेकिन आपका 1% अगर हर साल का बचता है तो उसके ऊपर अगर आपको 10% देना पड़े फिर भी 0.9% आपको बचता है. And 0.9% over a big corpus is a huge amount even for next 5 years or 10 years. So never try to be penny wise and pound foolish कि आप टैक्सेस बचाने के चक्कर में आप किसी और को आपका मेरे को नहीं पता कैसी रिटर्न आ रही है आपके पोर्टफोलियो में बट आई कैन 100% अश्योर यू इफ योर पोर्टफोलियो इज रनिंग इन करोर्स आपके एजेंट की कार आ चुकी है नहीं उसमें से दैट्स हाउ आई पुट इट टू माय फ्रेंड्स
About the last question, I would like to add one thing. The person who was investing directly in shares, the question was whether he should continue with mutual fund or not. So I would suggest that even if he is investing in shares directly, ELSS is a good option for mutual fund, provided if it does not have any other tax saving facility available, or ELSS will act as a retirement for fund him. Or worst case scenario, if the market crashes down, ELSS will still save his ass.
I have seen returns of ELSS. Most of them have returns between 14 to 17% for over 3 to 5 years duration. They are really nice option.
Only thing is the lock-in.
Yes,
Yeah,
yes.
3
Lock-in
years
period is
lock-in.
obviously there. Yes.
Anyways, we are investing in mutual funds for more than 5 years duration.
Any ATC benefits you are going to take, PPF has a locking period of 15 years.
Yes.
It's much
It has
lesser.
got least lock-in period of all.
Yeah.
And there is one question from Dr. Sonone. For someone who wants to invest in large, mid cap, and small cap, does it make sense to invest in mutual funds in mid cap, small cap category, and equity for large cap to be relatively safe? Bagli sir, would you like to answer this question?
My philosophy for choosing what type of fund you want to invest in, when the markets are very high and the volatility index is high, it is better to put your money more in large cap funds. And when the market falls, it is always better to put money in mid cap and small cap. See, the risk in mid cap and small cap is always much greater than the investment in large cap. So, when the markets have peaked, better to put your money in large cap funds because your money will remain more stable.
Yes. So this is smart investment approach. SIP is actually smart investment approach. What we routinely do is automatic debit, automatic investment. So SIP should be renamed as AIP. And there is one question from Dr. VC, and he wants to know how regularly should I track my mutual fund and fund manager. Harpal sir, would you like to answer this question?
Yeah, I would say once a year is more than enough,
Yeah.
but never less than 6 months. You don't need to see your mutual fund portfolio every month or every week or every quarter because that's not going to affect. Nowadays, even SEBI has regulated you receive the mail at the end of the month from every mutual fund that you own, how they have changed their portfolio. You can just have a look at that. And I don't think it will make any difference every month. I usually revise them after 1 year.
Okay. And there is one question from Dr. Amit Patil, and he wants to know whether there is any stop loss kind of principle with in mutual funds.
What's stop loss?
There is no stop loss.
Yes.
If the fund house or fund manager is consistently performing very poorly, say for a period of consistently 2 years or 3 years, if the returns are still negative, then it should be rethinked. It's not like stop loss, it's like switching the scheme.
Yes.
Or we can say rebalancing after 1 year.
Yes, portfolio rebalancing.
And there is one question by Dr. Sanjay Kshirsagar, and he wants to know, he had invested in mutual funds through HDFC Bank person. Now he is trying to switch or redeem fund, but it is not allowed on platform. How to do it?
Say it.
It's
And
not
reinvest.
possible. Either he's been sold something else in the garb of mutual fund.
Yeah.
It must be either a ULIP or an investment linked plan. If it's a mutual fund, he can redeem or he can even switch on MFUI.
Or it may be ELSS kind of thing which has lock-in period.
Yeah, but then that will specify if he knows the name. If he can share the name right here, we can let him know what it is actually.
Yes.
Even ELSS can be redeemed before lock-in period. The only thing
Yeah,
is
it
it will
can
be
be.
applied with exit load.
Yes.
Okay. Dr. Sanjay, can you share name of your mutual fund, whatever it is? And Dr. Anand Kavi wants to know dividend reinvestment versus growth funds. Is there anything like dividend reinvestment or dividend and growth fund?
You have an option whether it's a growth fund or a dividend fund.
Yes,
If
dividend
you are taking
reinvestment is
dividend,
growth
any
fund.
dividend above 1 lakh is going to be taxable in the hands of the recipient.
Yes.
So the charm of tax-free dividend is gone. So it makes no sense to have a dividend income against growth income, because growth, if you hold them on equity fund for more than a year, your tax structure comes down. Your long-term capital gain tax is only 10%.
Yes. And also compounding effect is better with
Absolutely.
growth.
So I think he sent the name as HDFC Growth Plus, right? If I'm not wrong.
I have not seen, sir. If you have seen.
HDFC Growth Plus is a ULIP, sir.
HDFC Growth Plus Fund. This is a ULIP
Yes.
and it is sold by HDFC Life, not by HDFC Bank.
Yes.
So he should file a complaint with the ombudsman, bank ombudsman, that he has been sold a insurance product in the garb of a mutual fund.
Yes. So your diagnosis was perfect, sir.
Yeah. Because I know these people have been doing this.
Yes.
मेरे हॉस्पिटल में ना बॉस जो हमारा सैलरी जिस बैंक में आता है उसकी मैनेजर बोलती है मेरे को कि डॉक्टर साहब एक ना आपके यहाँ डॉक्टर हैं जो किसी को पैसे नहीं लगाने दे रहे हमारे इंस्ट्रूमेंट्स में
वो मैं ही बोलना था.
मेरे सामने बैठा हूँ बता क्या बताना मेरे को.
So there is one question by Dr. Hemant, and he is asking, I will be getting a big amount in July. I am in higher tax slab. How should I invest it? So we had a detailed discussion about this. If you know how to invest and how to find the corrections, then you can do SIP. You can do smart investment. Otherwise, you can go ahead with direct one-time investment in ETF. Nifty 50 or Nifty Next 50. Otherwise, you can wait for corrections, and while you are waiting, you can keep the money in liquid funds. That was the discussion. There is one question by Dr. Kalpendra. I had one ULIP in February 2018. My agent is saying we can't redeem before 5 years. Is it true? HDFC Pro Growth.
Yeah, it's the same plan. So he should stop paying premiums after 3 times. He should not pay the 4th premium and say that, okay, that's the amount of money I wanted to give you, because this is minimum he has to pay.
Okay.
Otherwise the policy will lapse. तो 18 में दिया था तो 21 में तीसरा ही होगा ना, तो दे के उसके बाद उसको बंद कर देना चाहिए and let the money whatever is gone. So Dr. Kalpendra, just for your knowledge, congratulations, because your agent has got 50% commission in first year, 35% in second year and 30% in third year. So आपका पैसा उसकी जेब में चले गया, अब आप बंद कर दो उसको और देना, उसके घर का खर्चा हो गया 1 साल का पूरा.
That is huge amount.
Yeah.
So there is one more question from Dr. Kambir Chaudhary. I want to shift from Franklin to Parag Parikh fund. Is it possible on MFU? You will have to sell the Frankfin and buy Parag Parikh fund.
Yes. You cannot switch between the two AMCs.
Yes, two different cannot be shifted. Dr. Sanjay, he had asked about the problem. He is having ICICI Discovery Fund, Kotak Opportunity Fund. How to invest directly in European markets or foreign markets. So this is a question by Dr. Om Vijay. How to invest directly in European markets or foreign markets? Is it possible?
Many fund houses are providing such mutual fund which invest directly in outside markets. But looking at the growth trajectory of India, I think India offers much better return in coming years rather than going for abroad investment. As Dr. Bagli has already mentioned about rupee appreciation against the different currency, so that one factor is been lost. So staying with India and its growth trajectory will be a wiser option. It can be done for portfolio diversification, but not as a primary investment.
Is it available on MF Utility? foreign funds?
Yes, foreign feeder funds are available.
Okay. And there is one question by Dr. Anand. What is REIT fund?
REIT is Real Estate Investment Trust. It has been recently came into force in India, but the quantum of investment in it is on higher side. So till the product matures, I don't think we should advise it. But at such principally, the product looks good.
Okay.
REIT is actually a mutual fund of real estate. All these years, there were private REITs and they were floated by Piramal Group, and the minimum investment was 25 lakhs.
Okay.
But now, SEBI has enforced a lot of restrictions on REIT funds. They are now traded as units on the stock exchanges. Embassy Park was the first public issue of a REIT fund, and the second was Happy Minds or Happiest Minds, something like that. So two issues are already there, and they have a good performance. The fund manager invests the money from pool of investors into various commercial projects, either as a equity participant in the project or for rental yields. And whatever income is generated, minimum 90% of the income generated from these yields has to be redistributed back to the real estate unit holders in the form of dividends. So it's now pretty safe. The regulations are more strict, and REITs are here to stay. But there are only two publicly traded REITs on the stock exchanges as of now. They will come in plenty when the situation in the real estate markets improve.
Okay. So what are those two? Piramal and?
No, now currently one is I think Happy Minds, and the second is first one is Embassy Parks.
Okay.
Embassy Park was sold at I think 299 rupees.
Okay. Okay. So is it like a share? Means do we get
It's,
dividend on
you
it?
are holding a share of a mutual fund. It's like a mutual fund in real estate.
Okay.
They may lease the property commercially. They may buy the property and sell it at a higher price at a later date. There are various options available.
So how do they share the 90% profit with us? Means is it reinvested?
It's distributed in the form of dividends.
Okay. So we get dividend on REIT.
Yeah.
It is not a growth fund.
The initial REITs used to give this interest,
Uh-huh.
and it was a fixed committed interest, and interest was as high as 22% or 24%. Even post-tax revenue was 16%.
Uh-huh.
So that was very attractive. But because of very bad scenario in the real estate market following demonetization, most of the REITs have failed. But now, because SEBI has introduced a lot of regulations and have made 90% profit distributable, it is pretty safer.
And that is very good option.
Only thing, ticket size has been reduced from 25 lakhs to 2 lakhs. The minimum
Okay.
corpus you need to invest is around 2 lakhs now.
Okay. There is one question by Dr. Rajesh. What are in VIT? I don't know what is this question. Anybody knows what is in VIT?
Probably it is some investment trust. I know. I don't know much more about.
Yeah, it's some recent in which it is known, but I can't tell you details. It is something new, baby, coming up.
Okay. And there is one question by Dr. Rahul. How good or bad is investment in Scriptbox? What is Scriptbox? Anybody knows?
Yeah,
Scriptbox
it's
is a
again one
trading
of the aggregators which came very long time back, but didn't pick up so well.
Mm-hmm.
It used to give you very good detailed analysis of every mutual fund and then what to invest, where to invest. There are a number of them, so we can't go into the details of each one of them here.
So there is one question by Dr. Azagiri, and he wants to know how much percentage of our income can we invest in mutual fund. This is very interesting question. Bagli sir, would you like to answer this question?
Now, it depends on your age, your risk appetite, what your goals of investment, whether you have any ancillary source of income. So, whatever you can save, most of it you can save, put in mutual funds, because mutual fund is a safer route than direct equity. And those who have less knowledge of equity or investment world, safer option will always be to go through mutual funds. But how much? It's very difficult to advise. It depends on your, quantum of income, your responsibilities, your age, and your other sources of income.
Yes. So it has to be individualized. There
Correct.
is one question by Dr. Sandeep Devre. He wants to know about invoice trading. Can anybody answer this question? Invoice trading, what is it? I don't know what is it related
No
to.
experience with it.
So this is not the topic for today's discussion. There is one question by Dr. Ram Prasad. I have
Yes, please.
invested in HDFC Assured pension plan for over 10 lakh into 5 years, 50 lakhs. I have got very poor returns, which is less than 5%. What shall I do? HDFC Assured plan, pension
Answer
plan.
is in the question, Dr. Prashant.
Yes, sir?
The answer is in the question itself. If he's got
Yes.
5% return over 10 years, congratulations, your agent has already had a car to your name and he's driving it. So you better take your money back and invest it on your own.
Yeah. So returns are not good, then shift. And there is one question.
As
What is
far as-
better, RBI sovereign gold bonds or gold bees? Bagli sir, your favorite question, I think. Sovereign
See-
gold bonds or gold bees?
See, I would always, it depends on the time horizon. Sovereign gold bond is a very good product, but only thing is you have to hold it till maturity to save on taxes. Gold is a commodity which will always, hedge against inflation, and it will steadily go on increasing, though its return may not be as high as equity. Sovereign gold bonds are issued by the Reserve Bank of India. It gives you very paltry interest, that is 2.5% per annum, which is taxable. But if you hold it till maturity and then you sell or return the gold bond back to the government, you will get money which is totally tax free. There will be no capital gains tax if you hold them till maturity. Now, if your horizon is lesser than 8 years, say 2 years or 3 years, your shorter horizon, then you should put it in exchange traded, gold funds like gold bees, where if you hold a gold bees for more than a period of 3 years, it will be a long-term capital gain. This is 20% with indexation, and if you sell it early, then it will be addition to your income
Okay.
and taxed at regular rates. So basically, minimum period of minimum horizon should be 3 years to save on taxes. See, any investment, one of the most important goals in any investment is to save on taxes. Your pre-tax return and your post-tax return, there should be minimum gap. You should save on taxes. Your pre-tax return should be as close to your post-tax return as possible.
Okay.
And that is possible only if you have patience to hold the investment.
Then there is one question by Dr. Sanjay. He wants to know which is better for mutual fund investment, MFU or Zerodha Coin or Kuvera app. So I think we have discussed this in detail, and mutual fund investment through MFU is better as it has more options. And Dr. Rajesh has question, what's asset allocation philosophy? I think this is very vague question. If I sell a property and get lump sum amount, then should I use it to repay my loans or should I invest it to some good fund to get growth? Dr. Brijesh has this question. Harpal sir, would you like to answer this question?
Yeah. There's nothing like a debt-free life. The only person who knows how good a sleep is and enjoys is the person who is debt-free. So never invest with the free money that you have if you have debt on you. So debt is a big liability which can affect your family after if by any unfortunate incident you're not there. So take off the liability first and then except if it's a housing loan.
Okay.
Because housing loan is tax efficient. Otherwise, I would remove my debt completely and sleep peacefully at home.
Fine. So this answers that question. There is one more question by Dr. VC. Mutual fund versus small case by Zerodha. Which one is better? Hemant, would you like to answer this question?
Anytime mutual fund, because small case is just a compilation of companies what you deserve. or you decides. But there are professional persons and professionally trained people who take care of all the returns and all the expenses of mutual fund. So anytime hands down mutual fund is way above small case.
Okay. Any other opinion about this? So there is one
See,
question by Dr. Ajay. He wants to know about hedge fund. Are there any hedge funds in India?
Yes, there are many hedge funds in India. They basically work on the premises that they hedge their entire things, entire holdings, and they produce return in them. The exact working pattern is a bit complicated, but to give you an example, say you buy a gold physically, 1 kg of gold physically in a shop, and you sell 1 kg of gold on paper in market. So basically you earn from whatever the difference is. It is a bit of complicated issue. So at this basic level, I would suggest not to attempt for it unless you are quite expert in routine mutual funds.
Okay. The question about invoice trading was actually about invoice discounting. Does anybody know what is invoice discounting? I think we'll skip that question.
I don't have complete idea, but have partially read about it. What
Okay.
happens is it is just like iski topi uske sir. So invoice discounting, what people do is say Harpal sir, again Vishwas sir, Bagli sir buys something. They have some outgo, that is their invoice is pending against them. So what a mutual fund or a team will do is he will convert them into a debt. It will convert them into a debt fund, and he will sell it to Prashant with the premise that all of these are holded by doctors and they are supposed to repay it in routine manner in time bound fashion. So there will be a rating against it. As and when the repayment is done, the rating improves. As and when the repayment is defaulted, the rating decreases, and it is dynamically priced. But it is quite newer thing and a bit of intellectual exercise. So better to refrain from it.
We'll take last two questions now. I think it's 10:45. One question is, want to generate monthly income for parents. What instruments to invest? Lump sum amount. Money is generated from sale of property. He wants to monthly income from lump sum amount. So, Bagli sir, would you like to answer this question?
What is the quantum that he is looking towards? See, any income which is generated apart from senior citizen savings scheme, there is no concession on taxation,
Yes.
right?
Yes.
So, in senior citizen savings scheme has 50,000 rupees annual exemption from the income tax
Okay.
for mother as well as for father.
Okay.
So he should invest money in senior citizens so that the annual interest from each deposit is around 50,000, which will be totally tax free. Now, any other interest which is going to make is going to be fully taxable in the hands of the recipient. So, what is the option when there will be no tax, when less tax despite regular income is a commercial property or even a residential property if it's rented? The yield from the residential property is very poor. Yield from the commercial property is higher. So
Yes.
whatever rent he may generate from a commercial property, 30% of that will go in standard deduction. So only 70% of the amount generated as rent from a commercial property will be taxed in the hands of the recipient. So if you want to generate regular income which is to be spent, then rent from the commercial property is a very good source of income where you can save tax apart from senior citizen savings scheme.
Okay. So there are two options. One
One
is
there, sir,
commercial
one more
property, and
one
other
more
is
option of Varishtha Vay Vandana Yojana, something like that,
Yeah.
is having 8.5% guaranteed return.
senior citizen savings scheme.
No. It's
No.
Varishtha Vay Vandana Yojana.
Okay. So it is
I
separate.
don't know whether it is going on is in this financial year or not. It was there 2 years ago.
Okay.
Bagli sir, can you?
No, I will have to find out. Of late, I have not read it.
Because
But when I did my investments, I have
नहीं,
taken senior citizen savings scheme for
Sir,
myself and my
just
wife.
2 years ago, Modi ji has declared that Varishtha Vay Bandhan Yojana is having 8.5% of guaranteed return in interest. I say 8.5% is too good, na? For
But
senior
taxable.
Yes, yes.
But taxable
taxable,
होगा
yes,
वो.
yes, taxable.
हाँ.
Then it is.
Okay.
So there is one
Proceed.
question: if someone is getting personal loan at 5% per annum in Dubai, is it good idea to invest in mutual fund or equity? Loan should not be used to invest money.
I like to give one example. One of my cousin is in Dubai. He is in petroleum industry, and he went there in say 2000 or 2010 something. I don't know, but he was offered such a cheap loan there because loan is very cheap. So what he did was he picked up 75 lakhs loan. He did a FD in India, and after certain 5 or 10 years, he repaid the 75 lakhs and kept 75 lakhs for himself. I don't know how much logical it is or how much tax efficient it is, but it is being done routinely.
Okay, so this is one last question now. Is investing in reliable company PMS better than and safer than mutual funds? Bagli sir, would you like to answer this question about PMS?
Yes, see. Now let me tell you very honestly, portfolio management services are less regulated than the mutual funds. There is less transparency. Secondly, when you go through the mutual fund, this thing, there is no ticket size. You can start with 1,000 rupees or 500 rupees a month also, and you can put 5 crores also. But for PMS, there is a minimum ticket size according to SEBI of 50 lakh rupees. So the ticket size is big. That's number one. Number two, there is less transparency, no less regulations. Now it entirely depends on your portfolio management manager. If you churn your portfolio too frequently, you are entitled to pay short or long-term capital gain tax. Where in mutual funds, unless you sell your units, there is no tax liability on you. Right?
Yes.
So for me, for a small ticket investor, for a less experienced investor, it is always better to put your money in mutual funds than the PMS for these clear-cut reasons.
Okay, sir, fine. So there is one last comment by Dr. Nikhil. He wants to know ETF are less popular in India as compared to USA. Would experts suggest ETF? And Harpal sir has already discussed in length about ETF. It will conclude this session now. Thank you all the panelists for your time. It is almost 2 hours now from the discussion started. Thank you,
Thank you,
everybody.
my colleagues. Thank you, friends. It was a great evening. I enjoyed being a part of it, and I learned a lot from my colleagues as well. Thank you, Prashant. Thank you, Vishwas. Thank you, Harpal ji. Thank you,
Thank you,
Hemant. Good night.
Thank you, sir. Good night.
Good night.
Thank you, Hemant. Thank you,
Thank you,
Vishwas sir.
Prashant.
Thank you, Harpal sir.
Thank you.
Thank you very much, everyone. Thank you for being part of this.
Thank you,
Thanks,
Ashok sir,
Thank
for
you.
this
Oh,
platform.
Ashok. Good evening.
Good evening, sir.
Thank
Okay,
you.
sir.
Thank you very much.
We'll leave the
It was
meeting
really,
now.
yes,
Okay,
really
and stop
enjoyed
the
this.
streaming.
Recording stop.